we call it cash interest cover. That means the lenders are expecting that you should be having sufficient cash to be able to pay them their interest as it becomes due. They were not able to meet the target that is usually expected. So which means that they are still having financial challenges in that regard. We have also noticed that when it comes to the implementation of the action plan, although the way actions that were taken, they were not always effective because we have repeat findings. Are now going to cover you on the just overall the outcomes that we have observed in terms of the mandate that we execute. Moody did cover at high level, but just to reiterate, our responsibility, it is to audit the financial statement, it is to audit the performance information, and it also to look into whether the institution is complying with performance reporting objectives. In this regard, our observation is that the institution has been stagnant in that you still have material misstatements on the financial statement. In the performance space, that is performance information, there is one indicator that we had found to have some errors, meaning that did not have credible reporting when it comes to it. Compliance, you can see the lines that are indicating that it remained unchanged for a long time, which simply means...
Sorry, may I just stop you? So on the annual performance report, so you see where annual performance report, key performance area 2, markets, what does that mean?
Okay, now I'll explain it. They have two key performance areas that they monitor. There are others, but these are the ones that are very important. The market is the one that is looking into the operational targets that they have made, including the volumes, including how they're going to manage the ports and so on. That is the core KPI that drives the operations of the institution. The other one, it is mainly about the partnerships that they're wanting to strive, and then it had about just two indicators, but large indicators are sitting in the market, which simply means it's about how they are changing the institution in terms of the volumes, in terms of the revenue, in terms of the container moves, in terms of the ships, and so on. So that is the key area that is the key performance area that they are expected to deliver on. If that area is not delivered, then it tells you that the institution is not improving. Can I proceed, Chair? You're fine.
No,
okay.
Sorry.
Okay, I will cover. I'm just traveled by my gadget. It's too small.
Can use my gadget.
Can I just use my? You know, as much as you can remember all the information that you wanted to say, but if there is very little weights that you are seeing, it becomes tougher for you to present. Sorry, just one. I'll try and use a gadget that can be easier. Okay, thanks. I think the one that I'm having now is much better. But if you don't mind, just operate this one. I can take it and operate it. Okay, no, at least now I can read. Okay, thank you very much. Let me continue. I now start to reflect on the financial viability. Financial viability is about looking into whether are we seeing light or we are not seeing light. So in this case, I start by reflecting to the committee on the areas that we are seeing still weaknesses or factors that suggest that the institution is still struggling in terms of managing its financial performance. So the listed third items here are indicators that are saying the institution will, in the foreseeable future, still struggle with maintaining the financial sustainability. And the list that is in here is not exhaustive, but it is just giving you some indicators that we are still observing within the environment, telling us that the environment is still weak and requires better financial support in terms of ensuring that they are able to deliver on their mandate. Transnet, if you look into it, I had already indicated that the debt levels have increased. Primarily what you see is that almost every year they pay about 15 billion of interest. If you compare it to the prior year, it was 14 billion. If you convert it into on a monthly basis, it means on a monthly basis there is almost about 1.2 billion that gets to be paid out just as an interest to the financial institution, which means there is still high debt levels that are there. I want to also reiterate that we have also observed that government has come through and supported Transnet by providing some guarantees, so that the guarantees is not cash. It is just to say, if you go and borrow, I guarantee that I will be able to rescue in case you fail to pay a specific debt. So meaning is opening the institution to say you can be able to go and borrow, but it does not provide cash. What it means is that in the future, the debt levels are still likely to increase even more than this, because at the moment they have got guarantees that are approximately 192.8 billion, which simply means that is the room that has been open for them to be able to go and borrow more. That is what I wanted just to indicate. What we are also observing, there is short-term assets. Short-term assets is the quick cash that you can be able to utilize. So they must always be higher than the short-term liabilities. That is means the obligation that you have to pay the people with immediate effect. The short-term liabilities are higher than the short-term assets by 65 billion, which simply means there are daily pressures that they need to manage that they cannot be able to honor them, mainly because the net current liability is, they are sitting in a net current liability situation. They also have losses.
Sorry, I just want us to walk through this phase a bit slowly, if that's okay. So I'm going to ask you to start again, because the ratios are important. So let me just ask a couple of questions, and then we can go back to this. So I don't know if you would have it at hand, but I just wanted to get a sense of the debt to revenue, debt repayments to revenue comparison. So I think you said they pay 15 billion.
That is just interest.
No, I know. I mean the sort of debt service costs. Let me say debt service costs versus the. Well, I suppose what you're trying to say is that the payment, there is not enough. So let me simplify this way. So they are stretched in terms of the cash to hand.
Yes.
When you consider that they pay 1.2 billion a month servicing debt, in other words, paying interest on the debt, plus funding their operational obligations, plus meeting their short-term cash obligations. Would that be correct? Would I be describing it correctly?
That is correct.
That is good. So basically, that's what you're saying. Okay, all right.
And just to add, you'll see on the income statements, their revenue is around 86 billion. So think about it. If I am paying 15 billion a year of interest, that means I'm remaining with what to be able to use on the operation. So that is the trick that you find, and that is why, as I continue to reflect here, I also say the net cash flow from operating activities, they are reducing, meaning the amount that you are able to derive from your operation is going down, which tells us that they still have a long way to go in terms of improving their operations, therefore using their operations to be able to pay their debt and using their operations to be able to pay other aspects. And that is why, as part of the reflection, you'll see that we are saying in some of the instances they are using debt to be able to pay another debt. which is why you'll see the debt increasing. That is the issue, because the key is that an institution must be able to pay its own debt using the profits from the operation. But if it is not doing that, then it means in the future we're going to have much more problems than what we are observing. But in continuing, at the end, you are expecting an institution to achieve profit because this is a business institution. They don't have a profit, they do have a loss. And the loss that was there in the prior year was about 7.3 billion. In the current year, which is 24-25, the loss reduced to 1.9 billion. But we normally just wear the specs a little bit to say what informs that reduction. Is it operational improvements or is it something else? We did observe that the reduction is also informed by some provisions that were released, which then made them to be able to have some benefits on this in this regard. What it means is that I had anticipated to pay a service provider so much amount, but I was able to negotiate, and then I paid a lesser amount, meaning it is a reduction mainly in the amount that you were able to cycle. It was mainly for the Total Energies as well as Sasol litigation. So they needed to pay a specific amount, but they didn't pay the amount that they had originally estimated. They paid the lower amount, which then becomes more of an accounting profit in the income statements. That is why then you see that there is almost a benefit in terms of them reducing the loss. But our expectation is to say this institution must be able to generate its profit from the operation, not necessarily from the accounting elements. That is just what I wanted to highlight. But I also want to emphasize that you might recall Transnet was downgraded by the rating agencies in the prior year. That was around July. So that downgrade, what it meant is that they were in breach of the debt covenant. So it meant that they must go back and renegotiate the terms so that they can be able to continue. Otherwise, the debt were collectible immediately. So that, which is a majority of them, not all of them. So which meant that they had to go back and renegotiate, and that's when government came in and provided additional guarantees. Therefore, was able to allow them to be able to continue. So that is just the highlight in terms of the financial sustainability of the institution. The other graphs that are there are showing you.
So so if you don't mind, so I just want us to try and pull the story together then on financial sustainability. So right at the beginning, one of your earlier slides, you had spoken about the breaching of the debt covenants. So I'm just going to go there because I want to get the language correctly. Okay, so let us start. So it's that third last slide. It's a bullet point. Transnet financial position has deteriorated further, with its debt escalating from 137.6 to 144 billion. So did they get a facility? Was that as a result of a facility that they obtained, a debt facility?
Additional debt.
So they took on additional debt. I think
Yes.
that came from New Development Bank, right? If I remember correctly.
Is it one?
No, there was. Morning, Chair. There was actually a number of debts, but that was definitely one of them. So there, in terms of the breach of debt covenant, what would basically happen is that when...
No, I'm going to go there. So I'm just, so we're going to get, that's my next point. So I'm just saying, so they had to take on additional debt to plug the cash crunch that we're talking about just now, so which is your debt repayments, etc., etc. And you've just made the point that they're beginning to borrow to service borrowings as well, right? So that is the first thing. The second thing is that, so which now please address that second point. So that's the second point. So in terms of this 144.45 billion rand debt, they have agreements with their lenders to have a cash interest cover ratio of only 1.8 times. Can you explain that ratio? What does it mean in English?
Thank you, Chair. So in simple terms, so the 1.8 times is what they achieved. But what is sitting on the agreement with the lenders, it varies. With some of the lenders is 2.5 times and with some it's 2. And what it basically means is the amount of cash that they have should be able to cover the amount of interest by at least 2 or 2.5 times. So the moment that they fall below that ratio, it then basically means that there is a bit of a risk there, and therefore the lender has an option to recall some of those loans immediately.
Okay, so we spoke about 15 billion that they pay. So in other words, the expectation is that, and this is for the purposes of explanation.
Yeah.
The expectation is that they need to have around 30 to 45 billion, right? Which would be 2 to 2.5 times, 32.5, which would then be enough to give the lenders the confidence that they are able to meet their debt obligations, right?
Yeah.
In light of their other cash requirements in the business. So that is the story so far. What you are saying is that what Treasury do is to simply say, we will make good on the debt. So we will cover you, we will guarantee the debt that you have or that you take on. Right?
Yes.
Okay? Which means the cash interest cover problem almost never goes away unless the revenue from operations
Is able to
shoots up significantly. Would that be, I mean, otherwise where else are they going to get the money?
No, that is correct, Chair. And I think you've hit the nail on the head in that what we would ideally want to see, we want to see a Transnet that's able to generate enough revenue from its operations to service both its operational cost, meaning the cost of running the business, but equally must be able to generate enough cash to also deal with the infrastructure requirements. It's a catch-22 position in that if you don't fix your infrastructure, you are not able to generate enough revenue. And if you can't generate enough revenue, obviously you don't have enough cash to then service that particular debt. The other element of it is also that you could also look at it from a cost management perspective to say, yes, I want to make sure that my revenue is increasing, but equally, I also want to make sure that operationally when I'm running this business, I'm doing it in a manner that is also cost efficient. But the gist of it is really that Transnet need to be able to generate enough cash flow to support its capex requirements and also support its operations and service its debt. Thanks, Chair.
Is their capital expenditure requirement adequately funded, though? Have you made that assessment?
We have. Look, they always fall short of what they would have expected to get. And so, meaning their capital expenditure is not always adequate. So it's all about to say how much they can be able to fund. And you'll see when we get into the slides that talks about delayed and cancelled projects.
Okay, so you'll deal with that. Okay. All right, okay.
Okay, I think just in continuing with... Okay. No, it's fine. In continuing with the observation, you would recall that turnaround plan that we spoke about. It also came with the government guarantee conditions because government had provided a guarantee of 47 billion at that point. So in this case, the expectation is that when government provide guarantees, and then they also place specific conditions as to say, please meet 1, 2, and 3. So we then evaluated as to whether on those conditions that you were given, were you able to meet all of them? at the time when you had utilized the government guarantee, we can tell you that some had not been met, but the achievement was about 72%. That means the conditions that the shareholder as well as National Treasury had placed on them had not fully been met, but the amount was already fully utilized insofar as utilizing the guarantee. So, and we will also explain in the other slides as some of the initiatives that were meant to be honored and that had not been honored. I did cover the one of the recovery plan to say if the initiatives that are on the recovery plan were not fully met, so it means as much as the recovery plan term ended on the 31st of March 2025, there are still initiatives that have not been honored. So which means they are still under operational, they still have many operational challenges that they must fix. So meaning the turnaround plan has not yet yielded full result that it was expected to yield. They are continuing to implement those initiatives. We are hopeful that as they continue to implement them, then they will give the result. Ultimately, what you will also see from the volume side, especially from this perspective, when the recovery plan was designed initially, the target was about to say we want to at least by the end of the recovery plan to be hitting about 193 million tons. That is the volumes that we should be able to rail or we should be able to produce within the institution. When the year started, which is 24-25, they realized that that target was too high. They were not going to be able to meet it. They reduced it to 170. The actual achievement was 160, which simply means even the revised target of volumes, they could not be able to meet it. That is the indication that there are still operational challenges that they are needing to deal with. So that is from the volume perspective. And then all in all, what it means from the user perspective, what it means is that you still have a heavy reliance on the road as opposed to the rail. So ultimately telling us that there is higher reliance on the road, and then which will then cause the congestion in this regard, because it means instead of the train or locomotives taking the goods, you are having trucks that are taking the goods, mainly because the network is not able to function as speedily as it should be. So that negatively then affects the environment as a whole. So hence you will see in multiple recommendations we continue to say these operational challenges that are making them not to meet the volumes, they must be improved so that they can be able to meet their required volumes. We also make various recommendations about looking into the debt level so that they can be able to reduce it. I will make other recommendations later on, but there are others that are included here in terms of dealing with just financial sustainability. So which we continue to say they must look into the efficient ways of rendering this business so that they can be able to get into the profitable state. So that is what we highlight on this slide. But I want to then dive a little bit further on the infrastructure side so that one can be able to show you the observation. Some of the items that are in here I have already indicated, and I'm not going to repeat it, especially from the revenue side. We had to walk around the institution and ask ourselves as to say, what is the condition of the infrastructure on the ground? Some of the pictures that we are seeing there, they tell us that the condition of the infrastructure is really of a challenge in some cases, which tells us that, therefore, if the conditions of the infrastructure is at that state, they may not be able to deliver what they are expected. We could find some of the locomotives that were vandalized, and you would remember that the issue of the spare parts was one of the challenges that they've had in the past. They were using other locomotives to be able to repair other locomotives, meaning for them to be able to rescue themselves in some of these part agreements that were not yielding the result, then they will have to pause another locomotives, and then that locomotive gets to, they call it harvested, meaning I take the parts and then I go and restore another locomotives. But what does it mean? Then it means that you are having less locomotives to be able to rail the specific, meaning the specific volumes that you wanted to achieve. But equally so, you are expecting the rail network to be of good quality. Some of it you will find that some it has even been paused or it had submerged, indicating that there are really challenges when it comes to the impairment, when it comes to the repairs of this infrastructure. That that is why this slide also tells you about that there is still a big backlog of maintenance, meaning they have high number of infrastructure or assets that needed to be repaired that have not been repaired. Over time, you will see that there is almost a backlog of about 32.3 billion of just maintenance that is supposed to be done, but that has not been done over time. Meaning there are many assets that are sitting idly that are not being used, and mainly because they don't have enough funds to be able to service or to be able to repair these assets. That ultimately lead into them not being able to achieve the volumes. In these slides, we also reflect on you about the quantum of delayed and cancelled project. Delayed and cancelled project have got a big impact on the institution, because what you do is that you plan for the project with an assumption that once that project is concluded, you will be able to have enough capacity, or you'll be able to extend capacity, or you'll be able to deal with specific areas, both in the port as well as in the rail. There are many delayed and cancelled projects, primarily because of either the funding or there was poor planning in terms of dealing with the project. Some gets to be cancelled after spending millions, which then tells us that those millions would have been on the drain because they would not have yielded the result that the institution wanted to get. But we also want to reflect the fact that if you look into the bottom, if you remember the story about the 1064 locomotives, that is the locomotives that needed to be delivered to the institution for over years. Some have not been delivered. There are still locomotives that they are expecting to be delivered, have not been delivered. They are still negotiating with the suppliers for the suppliers to be able to deliver those locomotives, and which is also a story that we just want to highlight to say as soon as they are able to get these locomotives, we are then going to be able to see them getting their volumes or improving the volumes, because obviously locomotives are the ones that are assisting them to be able to rail sufficient goods on the ground. Chair, I saw that you wanted to say something before I pass.
Yeah, I don't want you to pass. Thank you very much. I don't want you to pass this slide. So I might jump around a little bit. So maintenance backlog, right? So maintenance underspend of 3.4 billion versus the required 10 billion, right? So I just want to be certain what you mean, which is, does that mean Transnet only had 3.4 billion available to spend versus a requirement of 10 billion, or for whatever reason they did not spend a 10 billion that was otherwise available? Which one of the two is it?
The divisions would have asked for 10 billion to be able to spend on maintenance, but they were not able to spend the 10 billion. They only spent, is it 6.6? The 3.4 is an underspend amount, which means they were able to spend 6.6 and then against the required of 10 billion for that particular year. What it means, therefore, is that the business were not able to get the required funds to be able to service the infrastructure that they wanted to service.
Okay.